Hello everyone, today we're going to be discussing the relative theory of money, a new monetary theory for the 21st century. But before we do that, we have to go over the current system and address what is money. There are traditionally three criteria for identifying what qualifies as money. The first one, store of value, just means that if you take whatever form of money you have and you put it under your mattress for 50 years, it should be able to buy you approximately the same amount of goods and services, equivalent amount of goods and services. So, very basic ones like bread or things like that can be counted, but perhaps not very advanced technological products because they tend to disappear or new ones emerge. A means of exchange, which means that you have a pretty good certainty that when you go to a store, your money will be accepted and traded for goods and services. And a unit of account, which means that you can use it to count things in, Excel sheets, to measure debt, or, basically just to count with. Because if you have money such as gold, for instance, it's very difficult to use it as a unit of account. You have to do it in grams, and it's not really breakable into its subparts, which is why we use money that you can break into, various subparts, with numbers. So let's take a quick look how the current money system works in a very simplified way, of course, because we don't have time to go into details. So let's assume we have three producers of goods and services, and they already have everything they need. They already have, like, this one has 5 corn, this one has 5 fish, this one has 5 breads. But there's no money in the economy. And they can't do barter because they want to trade in a circle. So basically this one wants to buy fish, this one wants to buy bread, and this one wants to buy corn. So they can't really use barter. So if there's no money in the economy, what you do is, that's when you require the services of a banker. Now, of course, in the current system, it's not like money is created out of thin air. You have to have some kind of a monetary base, as it's called, on top of which you can create debt. But let's assume that it's all debt. The bank can just give a credit of, say, 100 units of whatever currency. It puts minus 300 in its balance sheet. Now, these people have 100 people have 100 units on their accounts, but their accounts are at the bank, so they have plus 300 at the bank. Now, let's also assume that all of these are priced in the same way and they all want to buy from each other. Let's say that the price of a fish is 10, the price of a bread is 10, and the price of one corn is 10, just for simplifying purposes. Basically, there's just 50 that goes around, and so they still keep 100. The goods go in a circle, though. And they use the other 50, though, for investment. So this one buys a tractor for 50. Then sells the 5 extra corn that he can produce with that new tractor for 50 and gets 50 back. The arrow's pointing the other way. Let's see. So basically, it's obvious if you take out a loan of 100, you have to work to get back that 100 and repay the debt. So this one has a brand new tractor. I'm a very good drawer. This one has a new fishing boat. And this one has a new oven. So they can each produce plus 5 of each good. Trade with the person that gave them the new goods so they can produce more. And they get 100 back. Now they pay the bank back, and they assume that this gets crossed out. But they forgot that there's interest. So let's say they have to pay 10% interest. There's still minus 30 in the bank. And where does that money come from? I mean, they've each worked. They got the 100 back. They pay it back, but there's interest. The only way it works is if the bank lends them once again some more money. This time it lends 110 to each of these producers. They use the first 10 to pay back the loan and scratch this. And then they use the 100 again as an investment and to trade between each other. And so basically the way this current system works is a rollover of credit into infinity. And in the process, you have economic growth because they have higher production capacity. They can produce more efficiently. They have efficiency gains, productivity gains, all kinds of things. The assets in the economy grow because they can invest in buying a house or things like this. So that's how the current system works. Now, the issue with that is that it's a very, very complex system. You really have to make sure that this is the debt level / money supply, which basically means how much money is in circulation at a single point in time, which is, of course, debt money. And this is time as you move forward. So in the example below, you can say that, for instance, this is 300. The bank just created 300 out of thin air. That gets paid back gradually. But then, of course, where do those extra 30 that you have to pay for interest come from? They come from another credit that the bank awards, that there's 330. And then that gets destroyed over time. And then another, and another, and another. So money supply grows over time. And normally the growth rate of the money supply plus the velocity, which means the speed at which they exchange. So the number of times they buy, breads or corn or fish per day, which means the money goes in circle much quicker or slowly if they save up money and they don't spend it. Velocity is another parameter. This has to grow at the same rate as economic growth, basically. In order to have a sort of a stable economic system. So in this instance, if all goes well, then your debt, to GDP ratio stays the same. It doesn't vary. If there's a downturn, however, and the GDP doesn't grow as fast as the debt, then that's where you have problems. You can have defaults from consumers, individual consumers, or businesses. The economy slows down. The state gets into more debt. There's less confidence on the markets. The interest rate grows. And sometimes you have crises, and then you have a sort of a recession and plenty of different problems. Also, if there's too much money injected into the economy and not enough growth, you can have things like inflation. So too much money chasing too few goods. Or if there's not enough money supply, that is, people are not confident, they're not buying, or they might think that their money will buy them more goods tomorrow because there's a deflation. Then you also have big problems. And so it's the whole role of central banks and governments also normally a little bit is to make sure that the monetary system and the money supply matches the number of goods and services in the economy or GDP in order to have neither inflation nor deflation. And that's why they play around with interest rates. That's why they do all kinds of other things. The problem is obviously in today's situation with quantitative easing and all that stuff, you can see that money has grown at a rate of about nearly 10% until the crisis in 2008. You can see here it's in green, basically. Then it completely collapsed, which is basically nobody was taking out loans here. In this part, the economy sort of came to almost a tremendous slowdown because nobody was taking out new loans, which means older loans could not be serviced anymore, which is a catastrophic thing. And then it sort of picked up again. But how was the GDP doing here? It was not at 10% growth. But obviously, all of the money supply is not used for productive purposes. So you can have speculation in the stock markets. You can have speculation in real estate, existing real estate, which is one of the big reasons for the crises. And so as you can see, I mean, this is a very, very complex system. Now we're going to go examine how a system based on the relative theory of money works in the next video.